Let me introduce our first speaker today. So our first presenter is Peter Leahy from Highline Finance. Peter has over 25 years experience in banking, having held senior state and national leadership, origination and credit roles with 3 financial institutions, both in Australia and the UK, delivering comprehensive financial solutions to middle market businesses. Peter holds a Bachelor of Commerce from the University of New South Wales and an Executive MBA from the Australian Graduate School of Management. He's a Senior Associate of the Financial Services Institute of Australia, a graduate of the Australian Institute of Company Directors, and a full member of the Mortgage and Finance Association of Australia. Please welcome Peter Leahy.
Okay. Thanks, Wendy.
No worries.
And I love the way you said more than 25 years, because that made me feel a lot younger than what I actually am. So that was fantastic. How do I get out of that?
There you go.
Oh, look at that.
Yeah, magic.
There was some suggestion earlier that Richard and Barfi and I would give you a presentation on rugby union, but given as Collingwood won on Monday, we promised 40 that we wouldn't. So thanks for your time, folks. Debt versus equity, risk, and how a lender assesses risk. I'd say to you that in the universe of issues around funding for SMEs and growth companies, this is probably the most queried and least understood issue, not just for business owners and borrowers, but probably for banks as well. It's a big topic, so I'm going to try and distill it down into sort of 3 key themes. In fact, when the debt equity mix in a business is incorrect, for a business, it leads to an incorrect capital structure within that business. So if there's too much debt, it's overgeared, it challenges the sustainable cash flow of the business and could, in a worst case scenario, see a business go to the wall. If there's not enough debt in there and there's too much equity, chances are you've probably given away too much of the shop at too low a price, and the return on equity for business is way, way too low. However, banks get this wrong as well. And history shows over the last century that when banks get this debt versus equity equation incorrect, it has catastrophic consequences. Banks go to the wall, banks make losses, and in worst case scenario, they blow up their capital base. And I think we're all old enough in this room to remember the GFC of 2008-2009, where banks actually did go to the wall and had to be either sold off or bailed out by the taxpayers. Not in Australia, I hasten to add, but certainly in North America, the UK, and in Europe. So, I'm pointing in the wrong direction, Wendy, aren't I? Sorry, I'll try that again. Right. So if I point at you, you'll just hit the button. I see. Oh, right. That's how it works. Welcome to Vic Leader's Technology. Okay. So yes, it's a big topic. So I'm going to try and distill it down into sort of 3 key themes. But before I do that, I want to put some context around my presentation at 2 levels. And this is without any fee charged to Robert Ford, this is the cross-promotion of Vic Leaders. So I want to give not just my presentation, but the one that will follow and the presentations in Vic Leaders in the context of the strategic objectives of Vic Leaders, okay? And then to distill a little bit lower down, my presentation in the context of 2 previous presentations last April, which were around government grants and equity. So in a sense, mine's the 3rd leg of the trifecta around debt. And then the second point there, I want to use an interactive session with you, the audience, to basically talk through the debt risk versus equity risk from the sort of the risk-reward parameters, where you play the role of the debt provider or the equity provider, just to go through the process of the decision making as to whether to make a decision whether to lend money or to put equity on the table. Then I'll talk about the external factors that shape a bank's risk appetite. A lot of them, in fact most of them outside of their control, they're regulatory in nature and the nature of the business model. And then finish off with what's known as the 5 C's of lending. It's basically a model which has been around for 30, 40 plus years, longer than I've been in banking, longer than Rob and I have been in banking together, which is a true and trusted model for how bankers essentially approach credit risk. Let's see if this works this time, Wendy. Oh, look at that. But first, who's Highline? So I'm from Highline Finance, as Wendy said. So Highline Finance, from a legal perspective, is a finance broker. But at an operational level and from a branding perspective, we operate, as it says up there, a corporate debt advisory practice. And I'm joined by Ben Broadbent, one of my colleagues from Highline. There's a dozen guys in the Highline team. It was kicked off about 22, 23 years ago by a guy called Chris Edmonds. From my perspective, I'm in partnership with a guy called Bob Beard. Bob, in fact, used to be my boss. He was the state GM for NAB in Victoria when I ran corporate banking for NAB in Victoria. So what Highline does is help business owners navigate through the hurdles of the bank credit process. And I say bank, probably 80 to 90% of the funding that we arrange on behalf of clients is through banks because it is still the cheapest form of finance. But we deal with non-banks as well. And the services that we offer have become more and more important since the GFC, as banks have invested less and less in terms of the training of their staff regarding cash flow lending and the understanding of business, and they've become essentially big building societies building up their home loan books. So that keeps us really, really busy. We act exclusively for the clients, completely independent. And by that I mean there are some players in the market who do a little bit of what we do, but they will often have their own balance sheet. So in the funding structure that they'll put in place for a business, they might have a piece of the action, so to speak. At Highline, we think that's an inherently conflicted model because if I'm acting exclusively for the business, I will disclose to you what my fee for service is, and I'm not clipping the ticket on the way through by getting a margin on the debt that's in the structure as well. And as I said, we deal with banks and non-banks. So context about today. I'm just conscious of time, and Rob's going to remind me when I run out of time. So like I said, this is my cross-promotion for Vic Leaders. As the statement says there, Vic Leaders seeks to support and educate business owners navigate the long list of risks and challenges that SMEs and growth companies face. Okay? So through these presentations, but more importantly through the network that's created through Vic Leaders, so whether it's my presentation or the guys that will be following me, it's the alumni that's created through Vic Leaders, the networks, the education piece, and it's not just these sort of 45 or 50-minute presentations, it's access to people such as we industry experts that businesses can contact. So if you're here as a visitor and you haven't signed up yet to Vic Leaders, this is the sales push. Okay? It says up there, the CEO of an SME is the loneliest job in the world, and Vic Leaders is a substitute for the mothership. So what do I mean by that? Well, I spent 21 years at NAB, I think 40 years spent longer, but when you work for a large organisation and you're running a sales team, as I did on many, many occasions, and you're in charge of a P&L and a balance sheet and the growth and development of your people, you are actually sport rotten because you're working for a large organisation. So there's this thing called head office, which looks after those pesky issues like finance and accounting, sales and marketing, legal, compliance, IT, HR, web design, your digital strategy, and staff training. Well, if you're running your own growth business, you don't have access to any of that stuff. So you have to become a jack of all trades. And in a sense, the Vic Leaders model seeks to be the mothership for growth businesses. And I won't charge you for that 40 at all. Context number 2, and this is a little bit more granular, and if you are a member of Vic Leaders, you can go onto the Resource Centre and you'll see the presentations that have been made over the course of probably since day dot, Rob, okay? But if you go back to April's presentations, Tom Butler and Chris Gray at the back gave 2 fantastic presentations regarding, as it says there, Tom who's a Director of National Advisory, how to prepare your business for the ultimate sale or exit. And Chris, who is the guru of government grants, and if you are contemplating that or you want to navigate that jungle, which is state, federal and sometimes local government grants, Chris is your man to speak to. As I said, debt is the third leg of funding for a business. Because when you think about it, in the universe of sources of funding, the owners either put in their own money or get friends to put in money, or they attract equity from elsewhere. They borrow it, or they... G'day, Andrew.
How are you, Peter?
Yeah, good to see you, mate. Yeah, there'll be questions at the end. Or, if you're lucky enough and you've had someone like Chris tick all the boxes for you, government funding of some description. So this is basically, as I said, the third leg of that universe of funding sources for a business. Actually, I do encourage you, I actually bought hard copies of them, Chris's presentation and Tom's presentations. And a lot of the slides that I've been going to today cut across, particularly from Tom's perspective, in terms of assessment of risk and value. Okay? So I'll just put those down there. Okay, so why is it important to understand debt risk versus equity risk? Why is it important? Well, quite frankly, it's important because unless you understand this as a business owner and an entrepreneur, you're wasting time, energy, resources, chasing down rabbit holes, funding sources that will never come to fruition. And time is money in a small business and resources are thin on the ground. And if you don't know the right mix between debt and equity in your business and you don't understand the characteristics between the two, it's a waste of resource. Common question that I had over the years from people with a good business, with a good growth story, is what's put up there. Why won't the bank lend money to me that I need for my business? More often than not, I'll say, okay, well, tell me your story. What's the issues? And they'll explain it to me. And probably 90% of the time I'll say, well, I wouldn't lend it to you either. And the answer is because you are asking a bank to take on equity risk. And a bank will never take on equity risk for reasons I'll explain a little bit later on. So, and it's around the risk-reward paradigm. And if you look at Tom's presentation on equity back in April, he talks at length about the risk-reward paradigm from an equity provider's perspective. And it's actually analogous, but somewhat different to what a lender goes through as well. Hang on. How are you, mate? So, I've spoken enough for the time being. It's audience participation time. Practical example, equity. How many here have bought shares on the ASX? And those who haven't probably have because you've got superannuation, you're invested in the ASX regardless, right? Okay. So turn to the person next to you or the group of people that you came with, and just for the next couple of minutes, in the decision-making process around whether you buy shares and what company you buy in, contemplate those three questions. What are the risk considerations? What's the upside of the decision you made to buy shares? And what's the worst case downside? A couple of minutes. Okay, I'm just conscious of time, guys, so... Guys? Chris Gray told me if I move around a lot, the cameraman really likes it. Is that right? Okay, so who wants to volunteer now? What are some of the risk considerations? Anyone? Just yell it out. Stock market crash. Inability to execute.
Interest rates go up, stock market goes down.
Stock market goes down. What's the upside? What's the upside of buying a share on the stock market?
Share goes up, price goes up.
That's right. How much does it go up?
A lot.
In fact, it's uncapped. Theoretically, isn't it? The upside of equity is actually theoretically uncapped. Well, what's the worst case if you buy a share? You're going to lose the whole bloody lot. Okay, so go back and have a look at Tom's presentation in April, where he talks about the risk-reward paradigm from an investor's perspective in purchasing equity in a business. And he talks a lot about value creation and the risk-reward paradigm. That's essentially what he's talking about. So you want to get if you're making the decision to invest equity, your hard-earned, into a business, and of course the ASX is a very particular source of equity, it's largely the secondary market because you're buying existing equity that's in the market, but there are IPOs and there are share offers and all the rest of it. But it's still essentially the same decision process. So to summarise, equity providers' upside is potentially unlimited, but the downside is you lose the lot. And that, folks, is the essence of the risk-reward paradigm for equity. So I've got a couple of examples up there, and obviously I wrote this last week before the market tanked this week. But it's still essentially the same story, right? And I've just plucked two out of the air. CSL, the old Commonwealth Serum Laboratories, which listed in 94. I'm not sure if many shareholders in 94 that bought them at $2.40 for an equity raising of $312 million envisaged that today, I think it's about $250 today, but it's been as high as 318 or 319. We'd have spelling mistake, market cap of 130 billion, and that's essentially a return just on the capital value, not on the dividend flow, of 11,238%. Well, no share is going to give you an infinity return because that would literally be uncapped. But for mine, that's about as close to uncapped as you can possibly get, right? And then I just Googled unsuccessful IPOs, and there's a lot that have absolutely completely tanked. But this Star Combo Pharma, which, and I think it's fallen even further. After listing 50 cents, $2.03 today, trading at, I think it's about 14 or 15 cents. So if you got in at the peak, you've lost about 92%. Okay? But I could probably put dozens and dozens of examples up there. But you get my drift, right? Does that make sense? Any questions on that? So there you go, folks. You've just discovered what equity risk is. So similar exercise. Now, I said you're the lenders, but you know what? When you're putting money on deposit with a bank, whether it's in a term deposit or a transactional account, you are actually lending the money to the bank. So you are the lender. You've got contractual terms. It may be at call. It might be for a fixed term. It is for a fixed return. So quickly, this will be even quicker, I hope. What are the same considerations? Go. Okay, so quick, just shout them out. What are the risk considerations? Yep, that's right. So particularly today, where interest rates are heading. Yeah, I think the cash rate's at 85 points, but I think the 10-year swap rate today was a smidge under 4%. Last Christmas, it was 1.5%. So that tells you where interest rates are heading. Okay. Any other risks?
Whether they can pay back.
Yes, but there is a mitigant to that. So what's the upside? Yeah, but it's capped, isn't it? You know, but you know what the upside is, right? So if I'm putting money on term deposit, and I think today, Westpac's come out and offered 12 months at 2%. But until recently, you'd struggle to get 0.5% on any term deposit. But at least you knew what the return was. It was a known quantity. So what's the worst case? So I mean, someone did say they could go broke. There's a whole host of reasons which I'll talk about soon regarding the regulatory environment, which, you know, touch wood, they won't, because we do have probably the best regulated finance system in the world. And the GFC showed that up when banks in North America and Europe would have gone to the wall but for the fact that taxpayers stepped in. I think at one stage, half the banking assets in the UK were owned by the taxpayer. And that never happened in Australia. So it's the mirror image of what I spoke about before. The upside is capped, but the downside is mitigated to a degree. It's mitigated due to the regulatory environment, and a legacy issue from the GFC in 2008 was governments guarantee deposits at banks up to, I think the threshold's $100,000. Quick history lesson. When banks were in all sorts of strife in North America and Europe and were quite frankly insolvent, when you lose confidence in the finance system, the worst thing that can happen is you'll have a run on a bank. And if you don't think that can happen, those of us really old who can remember Pyramid Building Society and the state banks of Victoria and South Australia, and if you speak to your parents and your grandparents and your great-grandparents, but if yes, Chris.
If anyone wants to speak to Norman, he's just giving.
Yeah. So Norman, I was going to talk about the the depression of the 1890s, but I think that's a fair paper. But I think half the banks in the colony of Victoria went to the wall, and the Great Depression saw many banks go to the wall. But yeah, sorry, back to the history lesson. So the biggest concern was a lack of confidence in the financial system and whether there would be runs on banks across the world. And the Bank of Ireland, the regulator in Ireland, was the first bank to guarantee depositors' funds because the landscape of the banking system in Ireland was an absolute train wreck. Absolute train wreck. They got this risk-reward conundrum completely wrong. Speculative property development, they were betting the farm. So the Irish government stepped in, guaranteed deposits, but of course there's the domino theory, right? So once one, and remember they're part of the European Union, so if one of the members of the Union guarantees depositors, unless all of them do it, there's going to be a flood of liquidity coming into Ireland. And then that's essentially what ended up happening in Australia. So no Australian banks went to the wall, but Australian banks fund a third of their balance sheet overseas. I think it's a little bit less now, given there's so much liquidity in the market. But Australian banks needed government guarantees from the federal government to be able to go to the market back in 2008. I think that guarantee lasted for about 2 or 3 years. But that's essentially the difference. That's the risk-reward conundrum between debt versus equity. Okay, so this is the technology piece, right? Now that you've learnt the difference between the risk-reward between debt and equity, have a read of that. It's not terribly complex. What do I hit next, Wendy, to make this work?
Just the next screen.
Ah, the next screen. So have a read of that.
So have a read, and then in Mentimeter there'll be a question where you answer yes or no.
And this will test whether you've been listening for the last 10 minutes. Okay? Oh, good answers. God, they've all been listening. Look, isn't that good? Ah. There's always one in an audience, isn't there? Oh, there's two. Yes. I think we've got them all. My answer is if you're going to do it, don't do it with my money, do it with yours. But that's essentially it. Remember I said that I showed you the slide at the beginning where the common, not uncommon complaint I've heard from a lot of SMEs is the bank won't lend me the money. It's because of that. They're asking their bank to take on equity risk. Okay, so that's the risk-reward conundrum in which you've all solved for through an interactive session, so well done. So part 2. That's the summary. Debt providers, upside is capped, their downside could be significant. Equity providers, upside is potentially unlimited, their downside is 100%. So the debt provider will always seek to mitigate their loss through the taking of security, but they'll analyse within an inch of its life the recurring cash flow of the business. So why won't banks take on more risk to help me grow my business? Aren't they there to assist growing businesses? And this is part 2 where I talk about the external factors impacting the type of risk that a bank can take on, right? Sorry, there's a lot on that slide and the next one. But there's a number of reasons. Number one is regulatory. So the major regulators, the RBA and APRA, and it's outside the remit of a bank to take on equity risk. There's two key things that the regulators seek to protect within the financial system. One is, the second point there, maintain stability and confidence in the banking system, because lack of confidence leads to financial meltdown. But the first point is probably the most important. The most important stakeholder in the finance system isn't the borrower, isn't the shareholder, isn't the supplier, isn't even the employees. It's the retail depositors. Because the depositors fund the financial system. Deloitte's issued their quarterly review of the banks. I'll put this online actually, yeah. It makes for an interesting read. So it talks about the landscape of the banking system in Australia at the moment, and it talks to the funding structure of the banks. I think NAB is about 63% funded by retail deposits. CBA, and it's still the legacy from when it used to be a government-owned institution. There's this flight to the CBA when there's concern in the market. I think CBA is about 75% funded by retail depositors. And history tells us what's happened when they lose confidence. I spoke about the Great Depression, the Depression of the 1890s, the GFC. And as I've said, there's only one thing worse than a bank making too large a profit. Because when in the halcyon days, and our banks are still quite profitable, and people bemoan the fact that the banks make lots and lots of money, and I sort of understand that, but what's the alternative? You don't want to contemplate it. Because the finance system is basically like the arteries of the economy. And when they block up, you have financial meltdown. If you go back to the Great Depression, I think the Australian economy shrank 30% and unemployment hit 25 to 30% as well. So every time there's been a major issue in the finance systems over the last 120 years, there's been wholesale changes to how the banks are regulated to protect confidence in the market and the position of the retail depositors. Because banks get cheap funding out of you and me, the mug punters who put their money on deposit with the banks. The second point is it's systemic. Banks are highly geared businesses. Okay, so the capital base of an average bank, it's been enhanced since the Basel III regulations of 2008, 2009, but the capital base of the banks is now about sort of 11.5%. Okay, so close to 90% is a combination of retail deposits and other debt instruments, subordinated debt that they've borrowed from the market. So their business model, high volume, low margin, so leaves very little room for loss. So who's heard of the concept of portfolio theory? Give me an explanation of portfolio theory. No, it's okay. It's okay. Okay, so right from an equity perspective, if you're talking to an investment advisor or a private equity firm, basically the essence of portfolio theory says there's an allowable level of loss in terms of the investments that we make, because the ones that make a lot of money will more than offset the losses of the dogs. Okay, so they're going to chase equity returns of 15, 20, 30, 40%. And if they lose it all on other investments, that's okay, because they've made a whacking great amount of money on the ones that have been successful. That option's not available for a bank because, go back to their model, highly geared, high volume, low margin. So once you get to a certain level of loss, you've wiped out the profit you've made on all the others. And if you lose too much, you wipe out all your profit and you wipe out your capital base. So there's been a couple of other things in terms of the regulatory landscape. He says, talked about the GFC, Basel III. So Basel Conventions is the international body which basically sets in place the capital requirements for banks in the OECD. And the Basel II protocols came out of the GFC, which put more onus on the banks to set aside capital based on the inherent risk that they're taking. So for example, home loans, although the market's going to be tested in the next 2 years, isn't it? But historically, home loans, really, really safe, less capital would be put aside. Cash flow lending, where you're secured by a fixed and floating charge over a business, no bricks and mortar, more risky. The data tells us that. Put more capital against that. So that's what the Basel III protocols were about. But you'll remember the Banking Royal Commission, which was 2018, 2019. The consequence of all that is bankers are more wary, more risk averse, for all those reasons. So the bottom line, what this means for borrowers, banks cannot and will not entertain equity risk, because we know what happens when they get that wrong. And the final point I'll make about bank depositors is, if a bank depositor wanted equity risk, they'd go out and buy shares. So why would they entertain the prospect of a bank using their money to entertain equity risk? In other words, going completely against the decision they made in their investment choice, whether they put the money on term deposit with a bank or buy shares in the equity market. So the next obvious question is, okay, so what's the right debt equity mix? Is it a set percentage? And my answer is, well, it depends. It depends on the industry. It depends on the maturity of the business. It depends on a whole host of factors. But there are recurring characteristics between what constitutes debt risk versus equity risk. And I've tried to summarise that on that one page. And the one that I've highlighted, which comes through over and over and over again in assessing what true debt risk is, banks focus on the recurring cash flow. It's the certainty of the recurring cash flow. And you can see the characteristics of what looks like equity risk. Clearly startups. It's something new, hasn't been tested before. There's not a proven cash flow that underpins the risk that they're taking on. I'll put that slide up. It's an old favourite of mine. I spoke before about getting the right debt equity mix. The batting order, in terms of deciding on the capital structure of business, is decide what the debt capacity of the business is first before raising the equity. I deal with equity sources all the time, whether it's private equity firms or whether it's family offices and investors, and you talk to a lot of companies that have gone to these sources and they've raised equity and they come to see us about raising the debt. And I've said to them, well, how do you know how much equity to raise? And they said, oh, well, you know, we spoke to our advisors and we raised 10 million or 15 million or 1 million or whatever. The problem is you may have raised too much, in which case you've given away too much of the farm, probably at a really low price, or you haven't raised enough. And then you'll go to the bank and you've got this gap in your funding structure. So what we always say to clients is go through the exercise of debt sizing your business based on the recurring cash flow. And there's a bit of a guru who's run education sessions for all of the four majors, a guy called Michael Finley, and I went to one of his presentations about 9 years ago. I think you went to one of those too, Rob, didn't you? And he defined the debt capacity of a business as the present value, so the PV, of the cash flows available to service and repay the debt over an acceptable period of time, so in a commercially appropriate period of time. So the final piece that I want to run through is a model which I spoke to at length. And once again, if you remember, you can go to the Resource Centre from last October. It's a model called the 5 C's of credit analysis: character, capacity, capital, collateral, and conditions. If you look at Tom's presentation from last April, he uses a model called the octagon process of what they go through in assessing the equity risk considerations of whether they invest in a business. And there's a lot of parallels between the two. What I'll say the difference, there's a lot of overlap between assessing risk from an equity provider's perspective, but also from a debt provider's perspective. The two core differences is equity providers are looking at through the lens of value creation. And value creation can be today, but more than likely in the medium to longer term, particularly if there's an exit strategy for the equity provider. So if I'm putting money into a business as an equity provider, I'm trying to enhance the enterprise value of that business. Cash flow is one of the drivers that raises the enterprise value of a business. But if I've invested at this price, I want to get out at that price. So it's more longer term strategic thinking from an equity provider's perspective. A debt provider's perspective is around the recurring cash flow, because as much as I may be creating value in the longer term, it's the cash available to me today to repay the debt. So the 5 C's is just another model. You probably heard of the Porter's 5 Forces model, which talks about the relevant bargaining positions of suppliers and clients, the industry position, the extent to which a business is open to substitutes, and so on and so forth. It's just another model. So quickly, because I'm going to get the wind up soon. Character. Character is more than just sort of assessing the bona fides of the individual behind it. It's a multi-dimensional characteristic, right? So does the transaction make sense? Is the purpose legal? That's always a good place to start. And more importantly, is it on strategy? The amount of businesses get into trouble because they diversify into territory which is not their proven strong point. Think Woolworths and Masters. Textbook case of burning hundreds of millions of dollars worth of shareholder value. Think, and this is a point close to Rob's and my heart because we've spent a lot of time at NAB, think NAB buying some businesses overseas. There's one called Homeside, wasn't it, Rob? A mortgage servicing business in a different market, different legislative environment, and they burnt the best part of $1 billion in shareholders' funds. Management. So it's not just, yes, it's the depth of management, integrity, proven ability to deliver. And this is an important one, management's ability to meet or exceed targets. So when they budget, is it all blue sky, or is it founded on realistic assumptions? So there's some of the considerations that a bank will look at in terms of assessing the credit risk from a character perspective. Capacity, I think I've done this to death already, but it's back to serviceability. It's about cash flow. As it says there, cash, not profit. Profit doesn't service debt. Your business might be going gangbusters, but because you offer terms to your clients, what's actually happened is your debtor book's ballooned and you've actually created another funding challenge for your business. So banks will spend an inordinate amount of time, often supported by the accountants, assessing what is the true recurring cash flow of the business to service the debt. And what underpins the certainty of that cash flow? So what are the assumptions? Is it blue sky? Is it sort of wishful thinking? Is it a bit of that? Or is it underpinned by contractual income or businesses that they've dealt with, or clients that they've dealt with for years and years and years? So it's that word, certainty of recurring cash flow. Capital, it's the debt equity mix. Another measure of leverage is debt to EBITDA. So in other words, earnings before interest, tax, depreciation and amortisation, which is a proxy for free cash flow. It's not always the same, and the accountants are sort of nodding. But it's debt sizing against the earnings of the business. So to give you a bit of an idea, a debt to EBITDA multiple of sort of 1 to 2 is pretty modest. 2 to 3 is getting a little bit more aggressive. And you'll find with the banks, a debt multiple, debt to EBITDA greater than 3 times is getting pretty aggressive. And the banks will more than likely want to amortise that back, also repay that back, to somewhere south of 2, 2.5 within 12, 18 months, 2 years. So I'll give you an example. Bob and I have just done a deal for a client in the medical sector. It's about $25 to $30 million. They're looking at an equity event sometime in the next 2 years, but they want to scale up to make, basically dress themselves up to go to the market to raise some equity through a series of acquisitions, and the starting leverage on that from a covenant perspective is around 3.5 times. But it's a great business. It's got a diversity of cash flows, and at the end of the day, GP clinics are essentially sovereign risk because Medicare pays about 80% of their revenue, and Medicare is the Australian taxpayer, right? So these are all the sort of considerations in terms of the certainty of recurring cash flow, and the stronger that analysis is, the more likely a bank will leverage the business higher because there is less risk.
What was the funding methodology on that for those GP creditors? What were they paying? You saying the bank did 3.7 times?
The bank's covenant is 3.5 times,
Yeah.
so they were buying businesses at 4 to 6 times. Okay, so they're leveraging. So this was a business that had no debt, and 3 years ago, Bob and I financed them the ability to pay out a cornerstone equity provider that had about 30% share in the business, right? And then it's got such a robust cash flow, it paid that off in no time. It made other acquisitions in the meantime through cash flow, even though we provided an acquisition line of credit. And then they came back to us last year looking to scale the business up. Touch wood, although that's not wood, due to settle next week. Okay, so but because it's such an undergeared balance sheet now, they can go and buy businesses at 4 and 5 and 6 times multiples with a leverage position of sort of 3 to 3.5 times. They won't hit that, by the way. That's the covenant. That's probably, we've modelled it sort of in the high 2s because they've got all this unleveraged value in the balance sheet as it is at the moment. And is the working capital position correct? So in terms of the funding mix, in terms of the term debt, so are we matching the debt instrument against what's ultimately being funded? So a leasing or asset finance facility for a piece of plant and equipment, which is amortising over the usable life of the asset, so matching that. Or if it was an acquisition of a competitor business on a term facility, or if we're financing the seasonality or fluctuations in the working capital under the right funding structure as well. Collateral, otherwise known as security. Bankers use the phraseology secondary source of repayment, because you've probably now heard me say 1,000 times, the primary source of repayment is always the source of recurring cash flow. But to protect the bank's position and the retail depositor's position, because it's their money they're using, banks will more likely than not take security, not necessarily bricks and mortar, but generally a fixed and floating charge over the business, which gives them the ability to step in and take control of the business in a worst case scenario. So in a worst case, appointment of a receiver and manager to run the business pending a sale. And it may also include directors' guarantees. So getting comfortable with the primary source of serviceability, absolutely. But what's the fallback position? And conditions, how they document the loan. So the loan term, is the structure right? There's the duration of the facilities. Working capital facilities are generally annually reviewable. So if I'm funding fluctuations in the stock and debtors to fund the growth, that's generally a facility which is reviewed every 12 months. An asset finance facility is asset specific, and they're generally 3 to 4 to potentially 5-year terms, depending on the plant and equipment that's being funded. If it's a property business, if you're buying real estate, bricks and mortar, terms of up to, in the commercial space, 5, 7, potentially 10 years.
And where we've seen in the last couple of years, real estate has gone up so significantly, and what's gone on in the last week, and things are slowing down quickly, will banks come back and revalue things and say, your building's not worth this now and there's a shortfall and call in a difference?
This is sounding like the Royal Commission. It's a good question though, Chris. It's a good question. I had a conversation with one of the big 4 banks last week, and there's a step before that, and is around assessing the serviceability. So for example, the bank, who will remain nameless, is modelling the serviceability on where they believe the 90-day bank bill swap rate will be, what it will average over the next 12 months, what it'll average in year 2, and what it'll average in year 3. And then using those shaded rates, seeing whether the business still generates a 2 times interest cover. So interest cover is essentially earnings before interest, depreciation and amortisation and tax divided by the interest cost. 2 times is generally the benchmark. They want to make sure the interest is covered twice. But what the banks are doing now is sensitising that interest rate. Now bear in mind the 90-day bank bill rate 6 months ago was less than 10 basis points. I haven't checked it this morning, but I think it's about 1.3, 1.4%. But anticipated this time next year to have a 2 and potentially a 3 in front of it. So what the banks are doing first, Chris, is they're sensitising the serviceability first. And it could well lead to, and they control, I think they've largely learnt the lessons of over-leveraging against real estate in the past. So they tightly control who are their panel valuers. So not, the bank have approved valuers who are on their panel, and they value the asset for mortgage lending purposes. That's quite specific. So it's a more conservative approach to valuing the asset.
Hey, are you seeing the term interest rate risk management at the moment, given we haven't had to worry about it for the last 6-7 years?
It's a good question. So what Andrew's saying is are banks and borrowers focusing on hedging their interest position, so whether through a fixed facility or interest rate swap. There's more activity, what I'm hearing at the moment. It's interesting. The rate rises we've had over the last couple of months was the first time there's been rate rises by the RBA since 2010. So we've essentially had a generation of borrowers who've only known one thing, and that's continual cuts in rates. So they've ridden the slide down and basically had most of their facilities floating. In fact, the only remorse, most of the remorse I've got from borrowers over the last 10 years is they've gone out and taken interest rate protection only to see the rates fall further and say, I'm out of pocket. And I said, well, not really. You've got certainty. It's a bit analogous to the guy who insures his house and then bitches that it doesn't burn down. So yeah, there is more activity. There is more activity, and like I said, the 10-year swap rate is knocking on the door of 4% at the moment, and in November 2020 it was 0.75. So the long end of the curve, as they say, the longer term interest rates gives you an indication of where the market thinks the shorter term rates are going to be at that time. So rates are going up, and they're going to continue to go up.
Quickly, Pete, leading on from that question, in terms of your
Thanks, mate.
business at the moment, in terms of your business clients at the moment, what are some of the, it's hard to ask like a broad industry type question, what are a couple of the key factors you'd be looking at if you're looking at, in terms of those businesses, looking at hedging some of that at the moment?
Sometimes it's a blend, right?
Yep.
So there's different hedging instruments, and you're probably best getting one of the treasury experts there. But there's, some people will play the market and keep it floating, and a portion of their debt they'll fix it.
Sorry, what I meant is in terms of, like, from a business perspective, what are some of the indicators that you'd be looking at in terms of actually looking to fix a portion of that debt for that particular business? So,
At the risk of sounding like a broken record, it comes back to what I said before. It's the certainty of recurring cash flow. So understanding of the drivers of the cash flow of the business, okay, and the potential variability in that cash flow. So to the extent that there's greater variability or risk of loss of cash flow is probably a greater case for fixing your cost of funds, albeit it's heading up at the moment. I'm getting the wind up, I think. Last 4 minutes. Okay, this will be quick. Finally, look at that. So they were the 5 steps. How do you make the bank's life easier? By adhering to this. So I'd summarise that by quality information, realistic assumptions regarding your forecasts. As I said there, know the cash drivers of your business, and regular communication. Banks hate surprises. So that's really around actively managing the relationship with the bank. Flag things with your banker beforehand. There's such a churn in bank managers through portfolios. I think there was a stat a couple of years ago that in the middle market, businesses get a new bank manager every 11 months. So they quite literally don't have the time to become experts in your industry. No one knows more about your industry, particularly in the middle market, than you do. So educate them on your industry and take responsibility for the relationship. And I think I'm down to my last one for you. Look at this, right. Okay, so I said at the outset what Highline does, and a lot of what we do is we see ourselves like, you're seeing the footage on TV at the United Nations where they're all wearing the headsets, because there's all different languages being spoken. Okay, that's essentially what we do. Does anyone speak Portuguese or Spanish, by the way? Well, they're very similar languages, right? But there's little nuances, and essentially what I'm saying there is, from the owner's perspective, you're seeing a business owner is seeing opportunity and approaching the risk perspective from an equity provider's perspective, whereas the bank is looking to mitigate risks. So I've just given a couple of examples of there where the owner sees opportunity, they share a good news story with the bank, and the bank's saying, yes, what can go wrong? Okay, and that's the role that we play in sort of translating the specifics of the business and the opportunity into a good news story about how to appropriately fund that and mitigate the risks that a bank will see. And that's me. Any questions?
Thanks very much, Peter. Put your hands together.